It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday morning. President Trump insists Iran's nuclear sites were completely destroyed, despite a Pentagon report that says otherwise. Oil rebounds following the biggest two-day slump since 2022. The Nasdaq 100 hits a record high. And it's the second day of Chair Powell's testimony. Treasuries tick higher as he opens the door to an earlier rate cut this year. Now, it is off the back of a Nasdaq 100 record high. Your S&P 500 just 0.8% away from another all-time high. Futures basically unchanged this morning. Some outperformance continues from the Nasdaq 100, but that's all thanks to lower oil prices that had traders pricing in the ability for the Fed to cut more. That is despite a Jay Powell who sounded basically the same as after the last FOMC meeting, that they can continue to wait. You're seeing oil, crude future, Brent futures up 1.4%, but again, that's after a big nearly 13-day, two-day slide. Your two-year yield, that's lower by about 4 basis points. Your 10-year yield unchanged. Both of these around the lowest level since early May. Let's get underneath the surface with your stocks to watch this morning is Bloomberg's Joe Easton. Hey, Joe.
FedEx shares down around 5% in pre-market trading today. The earnings actually didn't look too bad in terms of the quarter, but it's the outlook that's soft. And as Morgan Stanley describes it, it is squishy, which is a word I don't think gets used enough in analyst reports. But that stock sliding, they haven't given a proper guidance for the parcels unit, and that is weighing on the stock this morning. Then over in autos, we've got a bit of a boost for Stellantis today, upgraded over at Jefferies, who says that the North American model's actually selling better than expected, gaining market share for the maker of Jeep and other cars as well. So that stock sharply higher, up around 4% at the moment. And then finally, BlackBerry, the company I didn't know still existed until this morning, but apparently they do, and they're doing well in their auto software business. That stock up 11%. It's not the phones that we all know from 20 years ago. It's all about software. That stock higher as well this morning. And as usual, check out the Before the Bell opening wrap for a sum up of all these news and more, Danny.
I missed my BlackBerry phone. That keyboard, it was so great. Bring it back. Joe, thank you very much. Joe Easton there with your check on BlackBerry and other stocks you need to watch in the pre-market. This hour, we're going to be speaking to Kallum Pickering of Peel Hunt on Fed Chair Jay Powell's testimony and Sitara Sundar of JPMorgan on the continued market resilience. Now, no rush to cut rates. Here's what Fed Chair Jay Powell told the House Financial Services Committee yesterday on the first day of his semi-annual testimony to Congress.
The effects of tariffs will depend, among other things, on their ultimate level. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance.
Kallum Pickering, chief economist at Peel Hunt, writes, given the lags associated with monetary policy, because tariffs are likely to hit inflation earlier than employment, they set the Fed up to react late to economic weakness. I'm pleased to say that Kallum joins us now. Kallum, good morning to you. Thank you so much for joining.
Good morning.
So we heard from Hammock yesterday as well, who said, I would rather be slow and move in the right direction than move quickly in the wrong one. Is that the right or the wrong calculus to be playing right now?
That's probably the right calculus. I think we have to remember not just the outlook, but also what's happened. We have just gone through, around the world, in the US, a very bitter period of inflation in 2022 and 2023 that was partly the result of central banks, including the Fed, keeping monetary policy too easy for too long once inflation risks started to emerge. The result of that is that inflation expectations are not properly anchored. Even if we say, well, they're roughly on target, the reality is they're jumping around a lot whenever we get inflation surprises, especially to the upside. That means you have to be very, very cautious of working on the assumption that you can just look through this inflation. So unfortunately, credibility is at stake here for the Fed. It's probably right for the Fed to say we have to tolerate a bit more economic pain than we ordinarily would in order to make sure we don't have to worry about inflation risks. But I think once the Fed starts to move, actually you're going to see a succession of cuts. And so I think the market eventually will be happy with that. It's just a question of the timing of the first cut that's difficult.
To your point, Kallum, in that quote we read from you, the order of things would be first you get that inflation hit and then you get that unemployment hit. Does that leave them being too late? Does more economic pain come than necessary because of just the timing and the order of the data we're likely to get?
I think that's exactly right. When you think about the dual mandate for the Fed, you have the inflation side of the mandate, the employment side of the mandate. Typically, the Fed reacts more quickly and more aggressively to risks to employment than it does risks to inflation, but not this time around. That said, and I think this is a critical point, even though you have a serious policy problem, which is tariffs are a self-inflicted policy shock, the US economy is just not ready for a recession. It doesn't have the business cycle characteristics. It doesn't have the excess inventory. It doesn't have too many houses built. It doesn't have too much capital investment. It doesn't have too much credit excesses. And so you can probably take a shock without just automatically thinking this is going to trigger a recession. And I think that's why actually the market has rolled back its worries about a US recession. That said, the Fed should be, under these circumstances, anticipating the economic weakness and just cutting rates, but it can't. And so that's the problem. My base case for this year, I probably think we'll get around a 1.3% rate for real GDP. That's half of where we were last year. If the Fed could move in anticipation, you wouldn't have to see such a low number, but I think that's off the table.
Well, Kallum, you say that the Fed can't, but there's certainly some Fed officials who would like to move, who would maybe like to move as soon as July. It's a rare bit of non-consensus for an FOMC that tends to really unite and gravitate around one view. What do you make of Bowman and Waller really sticking out now as voices, more dovish voices, saying that July could be a live meeting?
July should be a live meeting. The meeting is not until the end of the month, and we have got basically 6 weeks of labour market data coming through. I just noticed in the Consumer Confidence Board survey yesterday, if you look at the balance of hard to get versus easy to get jobs, which provides a signal for the unemployment rate, it's now flashing an amber warning sign that the unemployment rate is going to rise. So I think there's a danger actually that we get some negative surprises on the labour market data. But conversely, we might see upside surprises on inflation. I think what these Fed members are doing is they're sending the signal for the future direction of policy. I think the dots are the best guide here. 2 more cuts before the end of the year probably means you go September and then at some point in Q4. I think the labour market would have to fall off a cliff before the end of July for that meeting to be a meeting where we can confidently expect a cut.
It gets back to this problem, though. If you have the share of respondents saying that jobs were hard to get, the most severe since COVID, but that's not actually playing out in the hard data yet, Kallum. Yep. It's this continued thing of how much can you trust the surveys? You're putting some weight on it. Why, when others have said, look, the surveys are unreliable, they're political, and it's not translating into the actual economic reality?
So last year, we had the signal in the survey. In this particular survey, this net balance in the conference board. We also broke the SARM rule, you'll remember, last year. We had this 0.5 percentage point rise in the unemployment rate. The Fed grew nervous. It reacted. It gave a 50 basis point cut. And I think we should keep in mind, if we didn't get those aggressive cuts late last year, economic conditions today would be worse, not better. And so the balance of risk today would be, under all normal circumstances, pushing the Fed already towards interest rate cuts. I think the difference this time around versus last year is last year was a bit of a mystery. Why are we getting this weakness in the labour market data? We still have lots of reasons to expect growth to be strong. This time around, if we see the weakness and we can point to the problem, which is, ouch, tariffs are going to shock both demand and supply, actually then we have some rationale as to why this signal might be justified. I think we need to be cautious, of course, but if we do see it in the hard data, we should start paying a bit more attention.
Kallum, I want to leave it with this, because you also write in your most recent research about the impacts of the uncertainty in the Middle East and maybe that turning into certainty. But I wanted to pick up on one piece that you wrote about, this issue of authority and credibility in Washington, D.C. What does it mean to have, if this is indeed the resolution and there's no further issues, or at least not to the extent we've seen, what does that do to the credibility of Washington, D.C.? And why is that so important at this moment as they're negotiating various trade deals?
If markets conclude that Trump and Washington's policy in the Middle East has been a success, it partly counters the negative hit to credibility that has come so far from the haphazard and heavy-handed approach to trade tariffs. Where, of course, on the other side of the Atlantic, whether we like it or not, the US economy is the conductor of the global economic orchestra and the market orchestra. In the end, we dance to America's tune, and so it matters for all of us if the US administration has credibility. And so when we're confident that looking ahead, the administration in the US will make decisions that are good for markets, good for the economy, that are pro-growth, then around the world we can start to take on risk. So I think this matters much beyond US shores. Even if the US economy weakens as a result of tariffs, the hope actually that in future you'll have better-minded decisions, I think is good for risk, and it's good for global outcomes.
Kallum, a masterclass as always. Thank you so much for joining this morning. Kallum Pickering of Peel Hunt. Let's now get you some other top stories that are trending on the terminal this morning. A stunning upset in the Democratic primary for the New York City mayoral race. Former New York Governor Andrew Cuomo has conceded to 33-year-old lawmaker from Queens Zohran Mamdani. Mamdani's platform includes freezing rents and cracking down on bad landlords. The result isn't official yet. The next round of vote tallying is on July 1st.
Tonight was not our night. Tonight was Assemblyman Mamdani's night, and he put together a great campaign. I called him, I congratulated him, I applaud him sincerely for his effort, and let's give him a round of applause.
Europe's car market picked up slightly in May, driven by demand for electric and hybrid vehicles. However, Tesla continues to lose market share. Its deliveries in Europe fell 28% last month. Growing competition and CEO Elon Musk's political persona has hit demand. Elsewhere for Elon Musk, SpaceX launched a historic private astronaut mission to the International Space Station. The Axiom 4 is carrying the first ever people from India, Hungary, and Poland. Originally slated to launch on June 11th, the mission faced 2 full weeks of delays. Coming up, mixed messages. The Pentagon says only limited impact was done from Iran's nuclear facilities, while President Trump calls them completely destroyed. We'll discuss that coming up next on your Bloomberg Brief.
That hit ended the war. That hit ended the war. I don't want to use an example of Hiroshima. I don't want to use an example of Nagasaki. But that was essentially the same thing. That ended that war. This ended that with the war. If we didn't take that out, they'd be fighting right now.
Mr. President?
Yeah.
If the Iranians do rebuild, would the United States...
If they rebuild?
Would the United States strike again? And I have also a question about Russia.
But I'm not going to have to worry about that. It's gone for years. Very tough to rebuild because the whole thing has collapsed. In other words, inside, it's all collapsed.
That was President Trump speaking about an hour ago from the NATO Summit at The Hague. Joining us now is from Jerusalem is Bloomberg's Dan Williams. Dan, that report might contrast with some of the other intelligence we're hearing. What is our understanding at this point as to the damage done on Iran's nuclear sites?
Well, I think it's very hard for anyone to know who's not there, to know categorically. I imagine the Iranians themselves don't know. They probably haven't had a chance to dig anything out. The dust has only now settling from the war. We're talking just over about 30 hours since the ceasefire was called. And in terms of more impartial, perhaps more neutral assessments, that would require the entry of nuclear inspectors that Iran does not appear disposed to allowing in anytime soon. Right, what we have now is intelligence assessments based largely, as I understand it, on satellite imagery. Even this DIA report that was leaked to some media, including Bloomberg, stipulated that this was an initial preliminary report. Now, when we hear from President Trump, when we hear from his defense secretary, categorical statements like the obliteration of the Iranian nuclear program, it's worth remembering that the U.S. ally, Israel, that had an obvious stake in seeing these sites destroyed and was at war with Iran when the U.S. weighed in really to deliver the knockout blow, as was hoped by the U.S. and Israel, to these sites. Israel itself has taken a measured approach. It said definitely there was significant damage, but the full assessment has yet to be made the analysts are still looking over it. So it would appear that the jury, to a degree, is still out, but the allies appear to think that given the US's use of the biggest conventional weaponry, the most powerful conventional weaponry available against these sites, a lot of damage was done, potentially damage beyond anything the Iranians could hope to retrieve or recover from in the near future.
Well, you could even hear from the American president there that he doesn't think a rebuild would happen. He is confident in the destruction, maybe confident enough to post this on Truth Social, Dan. China can now continue to purchase oil from Iran. Hopefully they will be purchasing plenty from the U.S. also. It was my great honor to make this happen. How big of a surprise that Trump seemingly might relax some of the sanctions on Iran now?
Well, it's a big surprise to oil traders. It's a big surprise to U.S. policymakers. Sanctions against the Iranian energy industry, oil exports, has been a centerpiece of international policy when it comes to Iran containment, and certainly U.S. policy going back several administrations. As I understand it, the White House was quick to, should we say, roll back those comments to say that there is no review of sanctions in the works. And I understand that the president himself suggested that his intention was to bring to China's attention that he, as he put it, evaded or prevented a closure of the Strait of Hormuz. This is something that might have happened had this conflict escalated further. And in preventing that kind of disruption, he actually helped China by preventing disruptions to China's energy supply. Again, there's also a backdrop of what looks to be a Trump administration review of trade ties or trade or diplomatic negotiations with China over their long-standing trade war. So it would appear that this is another mixed message by Trump. Perhaps he's dangling both for the Iranians and for the Chinese the benefits of playing along with how he'd like to pursue those two parallel tracks. It's something I imagine will become clearer as the days coming up unfold.
Dan, thank you so much for that. That's Bloomberg's Dan Williams in Jerusalem. Let's now go live to The Hague, where Bloomberg's Oliver Crook is there. He's been at the NATO summit covering the meetings. Oliver, I'm just going to imagine that a lot of this has been overshadowed by the Middle East with Trump's journey there to the Netherlands.
Yeah, that's right. We just had that press conference where Mark Rutte, the Secretary General of NATO, and President Donald Trump sat together. Rutte really kicking off the conversation, saying that basically there's a big milestone here for NATO, really sort of unprecedented historic day, where NATO is set to agree to spend 5% of its GDP, particularly the European allies, on defense spending going into the future. This was, of course, one of the key demands of the Trump administration that Donald Trump started to make a few months ago, and frankly, an idea that would have gotten basically zero traction 6 months ago and been thought of to be completely ludicrous, frankly, and is now being adopted as policy at NATO. And so, Mark Rutte wanted to give Trump the credit for that, and I think that that's actually fair credit to give. I don't think anyone in Europe would have gotten to that level, or most of the NATO alliance would have got to that level without President Trump. And Trump sort of gave a little sort of lukewarm endorsement to all of that, saying that, let's wait till the agreement gets ratified because anything could happen over the next few hours. But then, as you say, Danny, that conversation was quickly sidetracked onto the question of Iran, about whether or not the damage had been quite as extensive as the Trump administration had claimed. But Trump was saying that basically that intel that was leaked was only a preliminary report and we don't know, while at the same time basically affirming everything that he's been saying over the last few days, that the nuclear facilities had been completely obliterated. But of course, the main order of the day is that the NATO agreement to spend 5% of GDP. There's been a bit of disagreement among some of the members of NATO, namely Spain, who said that, listen, we could meet our NATO commitments without quite getting to that level. That has got some criticism from Marco Rubio, who's also here. We also have Pete Hegseth here. So we're going to be watching that over the next couple of hours as the sort of question of Iran also overshadows the events. And we should say, Danny, that Emmanuel Macron a couple of days ago said that Donald Trump had actually broken international law by that bombing raid over Iran. So we'll watch for any one-on-one conversation between Donald Trump, Emmanuel Macron, and of course Pedro Sanchez in Spain, who's been sort of the obstacle in some of the discussions here at NATO.
Yeah, and we're just looking at live pictures of Trump in The Hague alongside. We also saw the French president, Canadian, and Keir Starmer from the UK, all speaking with each other, those three in particular. Oliver, thank you so much for your excellent coverage there at the NATO summit. A quick check on commodities this morning. Yes, there is a rebound, but that comes after 2 days of a nearly 13% decline. So this does little to erase that. Brent crude up 1%, NYMEX crude about 1% too. Coming up, we're going to look at the headlines, what's on the top of the major publications, including the stunning results of the Democratic primary for New York City mayor. That's coming up next on your brief. Let's look at the front pages this morning. First up, the New York Times leads with the New York City mayoral primary. Zohran Mamdani, the presumptive winner of the Democratic primary, has promised to lift the city's working class and serve as a model for the future of his party. He vowed to use his power to stop masked ICE agents from deporting, quote, our neighbors. His supporters warn that the fight is not over. He will now need to compete against incumbent Mayor Eric Adams in November. Next up on the Journal, the Israel-Iran conflict reviving Chinese leaders' interest in a pipeline that would carry Russian natural gas to China. The Power of Siberia 2 pipeline project had long been stalled due to disagreements over pricing and ownership, as well as China's reluctancy to deepen its energy dependence on Russia. The outbreak of the war in the Middle East has led Chinese officials to reconsider. Elsewhere on the front page of the Washington Post, the latest on the month-long battle between the Trump admin and Harvard. Two officials told the paper that the White House is ramping up negotiations after the elite school racked up legal winnings in court. The admin hopes for a deal by the end of the month that one insider says could be a, quote, blueprint for the rest of higher education. Coming up, we catch up with JPMorgan Sitara Sundar on the outlook for this equity market. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday. President Trump insists Iran's nuclear sites were completely destroyed, despite a Pentagon report that says otherwise. Oil rebounds following the biggest two-day slump since 2022. The Nasdaq 100 hits a record high. And it's the second day of Chair Powell's testimony. Treasuries tick higher as he opens the door to an earlier rate cut this year. So after a more than 1% advance yesterday, the Nasdaq is at a record. The S&P is less than 1% away from a record. We are a little changed this morning to slightly higher, more outperformance from the Nasdaq. A lot of the decline in oil helped yesterday in the hopes of getting risk on. Yes, it is higher by 0.8%, but that follows a two-day decline of 13%. Yields, those are also bid on the front end, down by about 4 basis points. Your 10-year yield, little change, both around the lowest level since May. Again, lower oil prices helping with that. More dovish Fed speak, having traders price in more rate cuts to come. About 60 basis points of cuts priced in for this year. Let's get some stocks on the move pre-market. With that is Joe Easton. Hey, Joe.
Hey, Danny. So we've got FedEx shares down around 6% in pre-market trading this morning. The company giving guidance yesterday that Morgan Stanley describes as squishy, an adjective I think should be used more in analyst reports. But the details of it are the parcel business not growing as much as expected. Potentially, a lot of that is due to tariff concerns, people potentially cutting back even as those tariffs get watered down. So at the moment, we are seeing FedEx lower and UPS, I should say, slipping as well in the pre-market today. Then over in the car space, we've got Stellantis, the maker of Chrysler, Jeep and all those other car brands, getting an upgrade over at Jefferies. The first time they've had a buy rating on that stock for around 9 months. They reckon the North America business is improving, gaining market share, potentially making up for weakness in Europe. And finally, BlackBerry, a company I did not know existed still until this morning, but the company is doing well in software. It's all about automotive software, so selling into the car market. It's not the old phones that we all remember from 20 years ago. It's all about the software. So BlackBerry shares up almost 14%, 13% now in the pre-market. Keep an eye on that one ahead of the open later today, Danny.
A blast from the past. Joe, thank you very much for your work this morning. Now, elsewhere, Fed Chair Jay Powell faces the Senate Banking Committee today. Here's what he said in yesterday's hearing before a House panel.
Policy changes continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance.
Treasuries are muted this morning, but there was a rally yesterday on those comments. Bloomberg's Mike McKee joins us from Washington. Mike, it is a Treasury market that started to price in more cuts, but was this really a more dovish Powell?
It wasn't really a more dovish Powell. It was more of the same Powell that we've gotten. I got to go to the dress rehearsal for this last week at the Fed's news conference. His opening statement today, from which that soundbite was taken, was almost word for word the same as what he said in his statement at the press conference. The Fed hasn't changed its views yet, although a couple of members are a little more open to the possibility of an earlier rate cut. Powell tried to straddle the line and say if things work out where inflation doesn't rise too much and unemployment does start to rise, we could cut earlier. But he didn't put any timing on it. And the Fed is still looking at 2 rate cuts by the end of the year, he said, which was what was in their dot plot last week. So not much changed there, but maybe in the market's perception.
Well, in the run-in to this, Mike, you had a lot of harsh public criticism, be it from the president, the vice president. This was expected to be a grilling match. Was it? And will we get that in day 2 today?
No, he got asked a couple of times politely by members of the House Financial Services Committee about why they are waiting and not moving now. But I don't expect the Senate to be anything different because the senators tend to be more deferential anyway. And he has a good relationship with members of Congress. He spends a lot of time up on Congress, meeting with individual members. There was one junior member yesterday in his first term, and Powell said, I don't necessarily have an answer to that question, but I will come see you and we'll talk about it. So he retained some goodwill up there, and it's probably not going to be a grilling, probably not going to be a whole lot for markets to chew on today.
Mike, we really appreciate it. Thanks for bringing us the latest. That is Bloomberg's Michael McKee in Washington. Now let's turn to this equity market. JPMorgan Sitara Sundar anticipating a strong year ahead for equity, writing, quote, U.S. equities are expected to remain resilient and potentially reach new highs over the next 12 months. This optimism is being driven by strong corporate earnings, particularly from major tech companies. I'm pleased to say that Sitara joins us now. She's head of alternative investment strategy at JPMorgan Private Bank. Very prescient because you wrote that before we hit all-time highs in the Nasdaq, Correct. And we're also almost there on the S&P 500. So is this a rally you want to continue to ride?
I think so. Look, I think the entire sentiment so far this year has been this push and pull dynamic between bullish indicators, which has been strong earnings growth across the board. Obviously, like tech has been leading the way, but we've seen breadth and strength in earnings growth from financials and other more cyclical oriented sectors. But we've also had more bearish indicators too. We've seen a confluence of volatility around trade policy, geopolitical uncertainties. But when we look at that entire mosaic, at the end of the day, when we're thinking about equity markets moving forward, we have to look at the signal through the noise and focus on what the fundamentals are telling us. So when we look at the next 12 months, earnings growth is definitely going to decelerate, but still be strong. We're still seeing and expecting mid-single digits to high single digits earnings growth. And we're expecting that breadth to continue to broaden. And from my perspective, when we're thinking about investing within equity markets here, you need to see that breadth. You need to see more players come to the table. So while we still expect that tech is going to lead the way forward, and actually, I was honestly surprised to see this when I was looking at this yesterday, tech is now one of the best performing sectors so far this year, which if you think about that and the volatility that we've seen in that space, that secular growth, the optimism around artificial intelligence, that CapEx spend, that incremental news that we're getting from companies that artificial intelligence is actually being adopted a little bit more and actually leading to increased productivity, we're actually starting to see the stock market focus a little bit more on those fundamentals, which makes us constructive moving forward.
I have to say, I did see some notes yesterday that kind of made me feel crazy that were like, oh, geopolitical tension is ebbed, therefore buy tech stocks. It feels kind of crazy in that context to buy, but it is what worked. It was the old leadership of NVIDIA, AMD, Broadcom, things that led us higher yesterday. If that is one thing that is sure, that the AI continues to dominate, the spending is there, why do you still see breadth? Why is it not concentrated more into that leadership?
So it's a phenomenal question. When we think about artificial intelligence, I think the biggest point that I can tell investors is that it's bigger than just a technology story. It is a platform technology in which innovation across all sectors is going to be built upon it. That's why we're so constructive on it. Honestly, if it was just a technology play, I think that's a little bit more difficult. Obviously, the S&P 500 and even broader equity market indices, a majority of it is technology. But the thing that gets us the most excited is that artificial intelligence, agentic AI, which is still in the early innings, but we're starting to explore that a little bit further, and the application layer, that has impact not just on technology and software, which obviously we're very constructive on, but increasing efficiencies and automation when you think about the industrial complex, robotics, when you think about manufacturing, and that's a confluence of two different things. One, reshoring, bringing manufacturing back to the United States, but also increasing efficiencies within that ecosystem. It has the ability to permeate across all of these different sectors, which is why we, and I think the street, are so optimistic on this trend. And that also means, though, that we need to start seeing other companies outside of just technology-oriented companies start to adopt this. And that's what we've seen so far this year.
Right.
Financials, even our own firm is starting to adopt artificial intelligence, LLM, trying to incorporate all of those types of technologies into our ecosystem in order to improve productivity, which we're seeing in real time.
So that's one of the things that is sure in this market. There's still a lot of uncertainty, and there's some real risk this summer. July 4th, the one big beautiful bill deadline. July 9th, the trade deadline. Then you get into August, and you get the deadline for the Chinese tariffs, too. How do you position ahead of all that uncertainty?
100%. Portfolio resilience has been something that we've been talking about ad nauseum, understandably, so far this year. So what does that mean? The biggest thing for us is that what a resilient portfolio looks like over the next cycle is honestly going to look a little bit different than what it looked like over the past cycle. So when we think about the environment that we were in before, it was in the post-GFC period up until 2022, above average economic growth, especially within the United States, low inflation, and near zero rates. That led to a different type of portfolio construction where stocks and bonds were doing what they were supposed to be doing in terms of being negatively correlated. We still expect them to be negatively correlated moving forward, but that traditional 60-40 portfolio may not be enough to hedge against all the risks and the uncertainties that are out there right now. So the biggest uncertainty that we're really monitoring is thinking about what the confluence of below potential GDP growth, still solid, but below potential GDP growth, plus slightly higher rates than we were in the past cycle, and slightly higher inflation. So when we look at those things, trying to hedge against that elevated inflation risk and looking for inflation-protected income is where we're really focused. And what that means, it can either mean something like gold, where the intrinsic value is associated and tied to prices to a certain extent, but also in areas like infrastructure and alternative investments, because you have two different things. You have inflation-protected income because you have embedded inflation escalators within infrastructure, but also you have secular growth. Because of all when we talk about artificial intelligence, you need power to be able to associate and to power that entire trend. And now about 60% of the global infrastructure ecosystem is actually power oriented. So you finally have secular growth and that defensiveness with the inflation protected income. So when we're talking to clients moving forward, it's about adding that resiliency, but that definition of resiliency is changing.
Yeah, and resiliency, I think a lot of people, again, appreciate as we head to whatever the summer brings us. Sitara, thank you so much for joining this morning. Stay cool. Thank you so much for coming in studio. Sitara Sundar of JPMorgan Private Bank. All right, now let's get you some other top stories that are trending on the Bloomberg terminal this morning. It was a stunning upset in the Democratic primary for the New York City mayoral race. Former New York Governor Andrew Cuomo has conceded to 33-year-old Queens lawmaker Zohran Mamdani. Mamdani's platform includes freezing rents and cracking down on bad landlords. The result isn't official yet, and the next round of vote tallying is on July 1st.
Tonight was not our night. Tonight was Assemblyman Mamdani's night, and he put together a great campaign. I called him, I congratulated him, I applaud him sincerely for his effort, and let's give him a round of applause.
And a warning from the EU. Officials say that it will retaliate and impose tariffs on U.S. imports, including Boeing's, if President Trump puts a baseline levy on the bloc's goods. The EU is rushing to clinch a deal with Washington before tariffs on nearly all of its exports to the U.S. jump to 50% on July 9th. Meanwhile, the U.S. and Mexico are negotiating a quota system to reduce tariffs on a certain volume of steel imports. The move would alleviate crushing duties for some Mexican steel that's essential to U.S. automakers and other industries. Mexico is the third largest source of imported steel to the U.S. Coming up, President Trump disputes an intelligence report on damage done to Iran's nuclear program. We'll have the details for you next on your Bloomberg Brief.
That hit ended the war. That hit ended the war. I don't want to use an example of Hiroshima. I don't want to use an example of Nagasaki. But that was essentially the same thing. That ended that war. This ended that with the war. If we didn't take that out, they'd be fighting right now.
Mr. President?
Yeah.
If the Iranians do rebuild, would the United States...
If they rebuild?
Would the United States strike again? And I have also a question on Russia.
But I'm not going to have to worry about that. It's gone for years. Very tough to rebuild because the whole thing has collapsed. In other words, inside, it's all collapsed.
I won't use that example, but it's basically that. President Trump speaking at the NATO Summit in the Netherlands in the last hour as he reiterates that Iran's nuclear facilities have been completely destroyed. Meanwhile, the Pentagon saying that there was only limited damage. Joining us now is Bloomberg's Bill Ferries. Bill, a lot of back and forth. What do we understand? What is the latest readout from these various reports at the moment?
Hi, Danny. Thanks for having me. The latest news that we know from the Defense Intelligence Agency is that their initial assessment is that, in fact, those deeply underground fortified facilities were probably not destroyed. That includes the facilities that hold those centrifuges that enrich uranium up to a nuclear bomb grade. That's at least the initial assessment. Of course, there was a lot of damage done at the surface, but it does seem that the initial intelligence report says that those facilities may still, in fact, exist. Now, it doesn't mean they're doing any work. That doesn't mean they're enriching uranium. But it does make an important distinction when you talk about whether the Iranian nuclear program has been really destroyed or not. It does seem so far U.S. officials, the U.S. intelligence agencies, don't think it has been.
Well, perhaps in Trump's confidence that it has been destroyed and we've reached an end to this conflict. He had this on Truth Social yesterday, Bill. China can now continue to purchase oil from Iran. Hopefully they will be purchasing plenty from the U.S. also. It was my great honor to make this happen. Just how much of a surprise was it, Bill, that Trump is seemingly relaxing oil sanctions on Iran?
Yeah, that does have a lot of people scratching their heads. I mean, to begin with, China never actually stopped buying Iranian oil. China doesn't recognize U.S. sanctions on Iran's oil industry. They have continued to be the biggest single purchaser of Iranian oil and have really kind of helped that industry sustain itself in Iran. So I'm not sure. The president may be referring to the idea that it's perhaps the oil will keep flowing now that there's been this at least temporary ceasefire. But again, on the sanctions front, the president in this case doesn't have the authority to revoke sanctions on Iran's oil industry without a lot more paperwork, a lot more consultation with Congress. And our initial reporting is the Treasury Department continues or will continue to enforce sanctions against Iran's oil industry. So maybe President Trump is signaling his intention to make some changes, to push for changes in that sanctions regime, but it certainly hasn't affected China's behavior so far.
Bill, elsewhere on Truth Social, the president also putting this out, calling on senators to, quote, lock yourself in a room if you must, don't go home, and get the deal done this week. The deadline fast approaching for next week for the One Big Beautiful Bill Act. Bill, does it seem like we might get something of an agreement, especially when it comes to state and local tax deductions?
Well, we do have Treasury Secretary Scott Bessent, who was up on the Hill saying that he thinks they can strike a deal on those SALT taxes within the next 24 to 48 hours. That is one of the bigger hangups right now between the House and the Senate versions of this bill. The Senate does seem to be moving towards an agreement where they keep that $40,000 state and local tax deduction, but they perhaps change the income threshold at which it applies. Right now, the House version says it applies to people making $500,000. They could adjust that down a bit and have it phase out a little bit earlier, save some money that way. So we'll see. It's not the only issue holding up this bill, but the Senate's goal so far has been to have a vote this week that could include this weekend. That would get it back to the House for a vote that gets it to the president's desk by July 4th.
Bill, thank you very much. That is Bloomberg's Bill Ferries. Now, let's get to a stock that we've been keeping our eye on. FedEx falling almost 6% in the pre-market trade, 5.7% to be precise. Its first quarter profit missed analyst forecasts. The parcel company said it wasn't providing a profit outlook for the fiscal year due to uncertain global demand. Joining us now with the latest is Bloomberg's Katie Linzell. Katie, what was your takeaway?
So really looking at FedEx, there are sort of two interesting takeaways that we have here. Firstly, the forecast really not being what analysts were expecting. So disappointment there. We can point to sort of softer demand for packages, a sort of weaker US consumer. So quite a lot of disappointment coming out of there. And then also, if we look at the fact that FedEx was saying they were unable to actually forecast for full year guidance, which is very rare for FedEx. Normally they're able to provide that kind of forecast, that kind of guidance for investors and analysts. In this case, they were saying they're keeping it to the current quarter. So that really gives us a feel for how, for many businesses trying to operate in this kind of trade environment, the kind of uncertainty around tariffs, it's very difficult to kind of strategize going forward. So that was very useful, I think, for us all to see.
Well, to that point, Katie, is FedEx a bellwether at this point for businesses trying to navigate this environment?
I think it's useful to look at the company in that kind of context. Yes, FedEx has a huge range of clients, looking from manufacturers through to consumer goods companies and retailers. So really, they're able to get a gauge on not just the sentiment coming from other businesses, but also from the consumer, which is really useful. Also, their most profitable trade route, or the most profitable part of their business, is looking at that profitable trade route from US to China. And that is very, very important for them. They were able to report that in May, they really saw a sharp deterioration in that part, and also that they don't expect volumes to pick up materially. So in that way, yeah, it's a very important company for us all to focus on in this context of tariffs.
Of course, then you get the head scratcher. For some reason, cruise lines in the U.S. still doing well and still having demand. So unevenness out there. Katie, really great to have you on. Bloomberg's Katie Linzell. Thank you so much. Coming up, more earnings in day 2 of Chair Powell's testimony. We'll have your trading diary up next. Let's get you set up for your trading day on this Wednesday. Chair Powell will be resuming his congressional testimony, this time before a Senate panel. That starts at 10 a.m. We'll also get new home sales numbers. Those are also out at 10 a.m. Also get some earnings. Micron will be reporting earnings after the market close. A quick check on your bond market this morning, because we continue to see a real bid into the front end. Yes, 10s and 30s are little change, but check out what's happening on the front end. It had been anchored by a do-nothing, wait-and-see Fed, but we are down by about 3 basis points. You've had some commentary this week, specifically coming from Bowman and Waller about cutting sooner. Oil prices also coming in, helping on that front, too. All right, that's it for your brief this morning. Surveillance takes it from here on Bloomberg.